Well, good morning or early afternoon to everyone. My name is John Carpenter, and welcome and thank you for joining us today for another webinar to talk about probably the next topic in the Paycheck Protection Program, and that is the forgiveness piece. Joining me today are two of my partners, Chris Truitt and Deb Walker, both of whom are really tax specialists, and we appreciate everybody's time today. Here's a quick look at what we're going to cover. We'll talk a little bit about where we are right now in the PPP program. Touch just for a second on the other EIDL program. Primarily, we want to talk about forgiveness and how it works, and what are some of the calculations to keep in mind. What are the program limitations? We'll talk about the documentation that's required, what we know from from the banks and what they're expecting. We're going to talk about how PPP interfaces with and or does not interface with certain employment tax saving and deferral opportunities that are out there. And then lastly, we'll touch on what we as a firm are doing to help companies out there deal with the rest of the PPP program. And I should probably say at the outset, this is a live webinar. We did not record this ahead of time. So literally here we are at 12:03 Eastern time. And the information we're going to give you today is based on the guidance and the statutes as they exist right at this minute. It will change. SBA has announced openly as of over a week ago to say, to promise that there will be guidance, further guidance, and further changes regarding forgiveness. So to say we are expecting changes is an understatement. We are definitely expecting changes, and in fact, we could be getting some even before the end of the day. Sorry, I went one slide too many. So where are we with paycheck protection? Many of you who have been following the news know that the initial appropriation of $349 billion in CARES Act, and although it seems like a long time ago, recall that bill was only passed and signed into law on Friday, March 27th, and only 3 weeks later, the initial appropriation was completely committed to borrowers across the country through the network of 800 approved lenders working in that. And since then, many people initially thought, well, the $349 billion is quote gone, and that must mean that all the businesses got their money. Well, that's clearly not true. Although I'd say many more of them now have their money. That initial $349 billion was committed to a very long list of names of small businesses. But since that date when it was announced that the money was committed, the lenders have been working through an enormous backlog of applications that have been submitted to the lenders, but still needed to go through the process of underwriting and documentation, essentially allowing the lenders to check off all the requirements that SBA has put on them. We do know that some lenders have been continuing to take applications and notifying applicants that it is not approved and is subject to further appropriation. But I think they're trying to build a pipeline of applications that hopefully they can then fund pretty quickly, assuming that there are further appropriations coming. So where are we with appropriations? Some of you may have seen in the news that only 2 days ago, the Senate voted on another supplemental bill to the CARES Act that would appropriate an additional $320 billion to go into the PPP program. The Senate has approved that. It was sent over to the House. The latest I see in the news is that I think the House is expected to take a vote this afternoon. I have CNBC on in the background, and I don't see that it's been voted on yet, but things are changing quickly. Included in the Senate's bill and subject to approval by the House and signature by the President. We do note here that there was additional money appropriated for the EIDL program. That was also pretty widely publicized that program ran out of funding very quickly. So there's an additional $10 billion appropriated for the emergency grants. Those are the $10,000, call them spot loans. And then an additional $50 billion for the regular EIDL loans, which come at a maximum amount of $2 million each. So let's talk about forgiveness. So surely many of you perhaps now have received your PPP money. Some of you may have SBA loan numbers assigned and you're expecting your PPP money soon. And others of you may have applied and you're in that queue waiting for the next round of appropriations. But we have started to get a large number of questions from various clients and companies that have either applied or have gotten their PPP money about now what do we do? How do we handle the forgiveness part? Because as we've said in some of our earlier webinars, getting the money is only the first step. The back end step of this process is that every applicant who wants to get any of it forgiven has to submit an application back to their original lender to do that. So how does it work? There's a number of calculations that go into it. And as you'll hear us say today, unlike the upfront part, everybody should keep in mind there is a planning aspect to the forgiveness period. And it's worthy of putting some attention to the front end of how you're going to plan to spend the money. So basically in forgiveness, borrowers need to document how they are spending the PPP money during the 8 weeks beginning with the day of the first disbursement. Most banks we talk to are not making multiple disbursements. Whatever your loan amount is, take it or leave it. It's one deposit to your account. But as the guidance stands today, the day you receive your money is when this 8-week clock starts. You cannot go to the bank and say, well, can we wait a week? Can we wait 2 weeks? Can we wait till the first of next month? Can we wait till the next pay period? The clock starts the day you get the money. And you're going to calculate how you spend the money during that 8-week period. For forgiveness, once you go to apply for forgiveness, at least 75% of the forgiveness amount has to have been spent on payroll costs. And much like we talked at the beginning, we'll cover here again what is included in payroll costs. Now, I put a note here. We have talked to some lenders that have interpreted SBA guidance to say that if payroll costs are less than 75%, then the forgiveness amount is zero. And I have seen that guidance, and it's not very well written. And I do expect SBA will clarify it. But there are some banks out there that are questioning whether they can forgive any amount of the loan if payroll costs do not at least add up to 75%. This will be based on payroll records, payroll reports, and that 75% is going to be comprised of wages to employees. These are only employees whose principal residence is in the U.S. That does not speak to their citizenship, does not speak to what they declare as their tax home. It's all about what is their principal residence. We still have the limitation of $100,000 per employee. Most of you remember on the front end, you were only able to qualify for a loan up to $100,000 in annual salary per employee. Same applies on the back end. And SBA has simply given guidance that when you look at the math over 8 weeks, you take $100,000, divide by 52 weeks, and multiply by 8, and the resulting figure is $15,385. So that's the most forgiveness amount you can get per person. For those Schedule C applicants, sole proprietors, you're going to use your 2019 Schedule C income for forgiveness. There is no estimate for 2020. And honestly, it's kind of unclear how partner earnings, how K1 partners in a business are going to be handled. And there is no adjustment for tax withholdings or taxes paid.
John, let me just insert here that there's no mention of S Corp shareholders, and we interpret S Corp shareholders to be treated like any other employee of the S Corporation, although we may see guidance that says otherwise. So far, S Corp shareholders don't seem to be, shareholder employees don't seem to be lumped in with others. They're treated as employees.
Great point. Thank you. So we've had a number of questions about what can be included in these wages and what's not included, and the timing. And again, as we sit here today on April 23rd, all we can discuss is what's in the statute and what's in the existing guidance. But there are a number of questions that are really unanswered. We know the wages theoretically do start on the day that you receive your money, and it goes for 8 weeks. If you were to receive your money today, and if you were running a payroll, tomorrow's Friday, and if you're running payroll on Friday, our understanding is that even though that pay period would cover a period starting well before you receive your loan proceeds, if today is the lucky day, but our understanding is that that payroll you run tomorrow would be included in your forgiveness calculation. Conversely, on the back end, if you were receiving your PPP money today, look on a calendar and go 8 weeks out. Thursday, somewhere in June, at the end of 8 weeks, that's the end of your pay period, or end of your forgiveness period, excuse me. And thus, a payroll that you would run the day after your 8-week period would not be eligible to be included in the calculation. So what we read and interpret as of right now is that this really runs very much like a cash basis accounting project. So it is worthwhile for employers to look literally at their pay schedule and compare it to the calendar of when you receive your PPP money and how that runs for the next 8 weeks. Severance pay is eligible. There has been discussion of, should this forgiveness period be measured maybe starting with the next pay period or even the next fiscal month. But as we sit here today, nothing has come out to say that that's the case. We have had clients ask us what if there is a big payroll that's occurring, say, literally only a few days after the 8-week period is over? Is it okay to run maybe a partial payroll right before the 8 weeks is over? We think that's okay. Keep in mind, it is the levels of salaries being paid. There's no restriction on increasing employee salaries during the 8-week period. There are, and Deb will talk about in a few minutes, some conditions that employers should be aware of about decreasing salaries during the 8-week period. We've had a number of people ask about bonuses. Can you pay bonuses to employees during the 8-week period? Our belief is that that's perfectly fine as long as they're reasonable. We suspect that you're probably playing with fire if you declare bonuses that are equal to, and I'm just going to make this up, 50% of their annual compensation. And everyone, that would seem unreasonable. But in light of COVID issues, to give reasonable bonuses to a workforce, so long as your HR people are okay with your plan for that, then from a PPP perspective, we think that works fine. Keeping in mind, again, that even including the bonus payments, no single employee can get more than $15,385 during that 8-week forgiveness period and have it be included in the forgiveness calculation. And then the last note we have is that any mandated leave is really part of your wage base, and that's not an extra feature. One too many slides. Deb, I'm going to turn it over to you to talk a little bit about some of the other cost items that can go in.
Thank you, John. So once you get your wages, which is basically cash wages, and those are limited to $15,385 per person during that 8-week period, then you get to add some other things into payroll costs. And the other things are qualified healthcare costs for employees. It's clear that you can't add healthcare costs for sole proprietors there, and we assume for partners, but we don't really know that yet. Anyway, qualified costs are going to be the employer share of costs, primarily because the employee share of costs has already probably been included in wages. It includes healthcare premiums and a reasonable determination of costs for self-insured plans. We don't have any guidance on how you determine a reasonable cost for self-insured plans. Some of the other credits. Can you hear me? Am I unmuted now?
Yeah, we can hear Deb, you're fine.
Okay, thanks. So for self-insured plans, we don't have any guidance under these rules. We do have guidance from the IRS under the rules for the mandated paid leave provisions. And what that guidance says is you can look to COBRA cost, or you can look to an actuarial determination to figure out the cost for a self-insured plan. And again, it's the cost for employees for the 8-week period. It includes dental, vision, AD&D, flexible spending accounts, HRAs. It doesn't include qualified small employer HRAs. So let's go on to retirement plan contributions, because I think this is a big planning opportunity. Once you calculate what your total amount that you expect to be forgiven, if you don't have enough, you could in fact make a retirement plan contribution. And so the question becomes, well, how much can I make? Well, of course, retirement plan contributions are limited by the Internal Revenue Code. You don't want to get an excise tax for non-deductible contributions. And some people are even concerned that because this is focused on an 8-week time frame, that you can't just make a contribution for the whole week or for the whole year in the 8-week period. I personally think that you could, especially if it's a profit sharing contribution you're putting into the plan, you can't get it back. It's going to get allocated to all your employees. On the other hand, maybe a defined benefit contribution you would have to allocate. Unfortunately, we just have to wait for guidance, which fortunately they say is coming very quickly. And the last thing is state taxes assessed on compensation, which is state unemployment. But I think there's not too much planning in healthcare costs, more planning with retirement plan contributions, but we don't really know how aggressive you can get there. But it is not, neither of these are part of the $100,000 limit. So they're in addition to the $100,000 limit for employees. So what about mortgage and rents? Okay, as long as you had rents that were due or interest on mortgages for either real or personal property used in the business, these obligations had to be in existence on February 15th. You have to show that you had these obligations on February 15th, so you're going to be showing leases and promissory notes. We're not really clear if past due amounts can be included. It would make sense to me that they could, but again, this is supposed to be 8 weeks worth of costs, so we don't really know what'll happen with past due amounts. And then, of course, the home office deduction. If you have a home office deduction and you can document it on your tax return, I think the allocable share of your personal mortgage could in fact be included. So in addition to payroll costs, which includes benefits and retirement plans and cash wages, in addition to rents and mortgage interest, then we get utilities. And utilities include gas and electricity, water, transportation. We haven't really determined what, it's clearly in the statute. We're not quite sure what it means yet. Telephone does include cell phones. Internet access is part of utilities. Again, we run into the issue of prepayments and past due amounts. I personally am not too comfortable with prepayments. but I think we have to wait for guidance to know. So after you figure out the whole amount that you paid in the 8 weeks period, then next we have to get to the reduction in loan forgiveness. And there's a reduction in the loan forgiveness amount after you've calculated everything that you think could be reimbursed if you don't maintain employment levels or you don't maintain salary levels. So this slide shows you the fraction which you will have to reduce your forgiveness level by in order to, if you don't maintain your employment levels. And if you take a look at this, you can see that the numerator is always the 8 week period following loan closing. It's determined on an average monthly, average number of full-time equivalents per month, and you determine that on a payroll by payroll basis. We will for sure get examples on how to apply this, these fractions. But no, what you have to do is think about your payroll from June 15th, 2019 through 6/30/2019, or if you would prefer, January and February of 2020. Whichever fraction gives you the lower reduction is the fraction that you want to use. We'll talk about full-time equivalents in a minute, but these dates that you can actually go back and figure out what your employee full-time equivalents were, and that will help you to make sure that you have enough employees during the 8 week period not to have a reduction. Okay, the other reduction is going to be a lot less dramatic because that goes for reduced salary levels. On this one, you look back into 2019 and see who made less than $100,000. And if for all of those people that made less than $100,000, you can't reduce their salary by more than 25% during the 8 week period when compared to the first quarter of 2020, because everybody's going to get their loan in the second quarter. And this, to the extent there is a reduction, well, then it's a dollar for dollar reduction on your loan forgiveness. So I think in this case, you're just going to raise people's salaries up to where it would be so you don't see the reduction. And then we have a rehire provision. And the rehire provision is even less clear than the fractions that were before. But what the rehire provision says that if you laid off people before February 15th and April 26th, this Friday, 2020, you can rehire those workers and restore their salaries to the original level by June 30th and eliminate reduction for these amounts. So if you wait, though, if you think about it, if you wait till June 30th to bring your workers back, you won't have their salaries as amounts that were included in the loan forgiveness. So really, you have to have salaries having been paid in the 8 week period. So if you get your loan beginning of May, you're going to have to have paid salaries in May and June. And the fact that you can bring somebody back June 30th and it doesn't affect your fraction, or your fraction leaves you 100%, you won't be in as good shape because you won't have paid enough salaries. So I think in the charts I was looking at with yesterday with a client, it was pretty clear that keeping people on during this 8 week period was a better deal for obviously the people, but everybody, because the amounts were going to be forgiven. And that was not even taking into account the rehires. But the rehires, as I said, if you wait till June 30th, they haven't helped your 8 week covered payroll very much. And the last thing I want to talk about is how you calculate your full-time equivalents. Of course, we have no guidance on this with respect to this law. However, we have lots and lots of guidance with respect to the mandated healthcare provisions under Obamacare. And I gave the reg site here, but basically a full-time person is anybody who works 30 hours a week. And then for those that work less than 30 hours a week, you convert those people to a full-time equivalent based on 120 hours per month. So you add up all your part-time people, divide it by 120 per month, and then that gives you your full-time equivalent. So a half-time person would be worth a half a person in your full-time equivalents. And those regs are very detailed. They have a lot of examples. Assuming these regs apply, it will be pretty clear how to figure out full-time equivalents. And with that, I'm going to turn it over to Chris for documentation.
Thanks, Deb. So ultimately, the documentation that's going to be required is going to have to go to the bank, and the banks are probably going to vary what they're going to be asking for, but there's some things that we think you need to be keeping in mind in terms of what to have, and certainly that is going to be payroll tax filings, whoever your payroll tax provider is, the runs on a per employee basis, because they're going to want to see that we're limiting the payroll in total to the 15,000 and change for each employee. And I think there were some questions I noticed before that asked if someone makes more than the 15,000, do they still get included up to the 15,000? And the answer to that is yes. You just cap it at the 15, but they would still be part of your payroll for purposes of doing the calculation. Your payroll tax reports, your 941s, et cetera, unemployment filings would be included. Granted, those filings will cover more than the 8-week period, but I think they're going to want to see payroll runs and reconcile those back to the quarterly filings. So really just keeping up with all the payroll documentation, that's probably the easiest part because that's just part of the normal process. But as we've talked about, it really comes down to timing as well. I think the general thought process is now that we're going to be on a cash method of accounting. If you think about the purpose of the loan, it was to fund expenditures, these expenditures. So I think if we showed that the cash that we received as part of the loan proceeds was then used to fund these specific things, I think it kind of forces the thought process to be that it's going to be cash method of accounting. Which, again, as we talked about, means you might have to play around with some of your payroll cycles, and when things get paid, you'd hate to have a payroll for 2 weeks fall a day after the 8-week period. So certainly things that hopefully we'll get more guidance on, but we'll see hopefully in the next week on those kind of things. For the other costs, I think there's been some questions about prepaying expenses. One of the things I think when we're talking about rents that are going to have to be counted, you may very well have to provide a copy of the lease agreement because that will have to have been in place prior to February 15th. So in connection with providing that lease documentation, I think if you show that monthly rent is $10,000 a month, but yet you're claiming a rent expense of $120,000 for that lease, I think that's going to bring some scrutiny to that. So I think we have to be careful about that. I think a certain amount of catching up, maybe rents that are in arrears during the 8-week period, being current, may make sense. I think we should be cautious about making significant prepayments because we are going to be having to provide documentation as to what was paid and to what period it relates based on, having to provide those lease agreements. On the mortgage payments, same thing. I mean, I think you certainly can show the interest that's being paid. We'll probably have to provide monthly statements for that, and then utility bills as well. So I think it's making sure that we're capturing this information as it's being paid and kind of tracking this as you go is important. And I think when we talk about the 75%, 25% issue, I know there's some thought that if you don't hit 75% in payroll that nothing gets forgiven. I think that's probably not accurate. I think basically if you come up with your payroll costs and you divide that number by 0.75, that gets you the maximum amount that's potentially forgivable. And then the question is, do your other expenses equal that gap by taking your payroll costs and divided by 0.75? So those are just some things to keep in mind as you're going through the process and looking at the documentation. In terms of the timing, this is going to happen after 60 days. There's not as much of a rush. And when we think about what we were all having to deal with for getting the loans processed, it was a mad rush to get everything submitted. You had to get in line, first come, first serve. I think there's obviously a little more time that we have, especially to document the forgiveness. We do have 6 months of no payments, so it's not like you have to immediately start making payments. So I think a little bit more detail can go into the loan forgiveness documentation, and you just can't ask for, until you get to at least 60 days. One of the things with respect to the loan forgiveness that I think is obviously a big part of this is, as it stands now, the loan forgiveness is not included in gross income for federal income tax purposes. So you don't have taxable income if you get a $500,000 loan and you're able to document and have it all forgiven. That would not wind up being taxable for federal income tax purposes. There are some general tax rules out there that say if you incur expenses in connection with tax exempt income, then those expenses are not deductible. There is some thought process that to the extent you're funding payroll with the proceeds from this loan that gets forgiven, there is some question as to whether or not that payroll will be deductible or not. I think that's unclear. I personally think the whole point of having it be excluded from gross income is so that it is truly excluded from gross income. If you disallow the expenses that you paid with the exclusion amount, you effectively, in my mind, are including that in gross income in some respects. So we'll see. I think there's going to be additional guidance on that that'll be forthcoming. The other thing to keep in mind on the loan forgiveness and the exclusion from gross income, as we've all experienced over the years from a tax perspective, is for federal purposes, we get nice things like bonus depreciation and nice favorable tax guidance. Those are not always adopted by the states. So I think depending upon how the states adopt the federal Internal Revenue Code, some states will be taxing this loan forgiveness as taxable income. So I think, that's just something to keep in mind. I think we'd all be pretty happy if we at least get the federal exclusion and get as much loan forgiveness as possible, but just other things to be thinking about as we're going through the process. With that, I'll turn it back over to John to move forward.
Before we move on, John, there's just a couple questions I want to address. On the rehire calculation, it goes to full-time equivalent employees. They don't have to be the same employees. You just have to put bodies, the same number of bodies. And then the other question is, what about income tax withholding, federal income tax withholding, employer withholding? Some people applied for loans before the guidance was released, and before the guidance was released on April 7th, there was usually an adjustment for income tax withholding. So if you made that adjustment for income tax withholding in your loan, you will not make that adjustment now in your calculation of your payroll cost for 8 weeks. The rules changed on April 7th, and so that will give you, you just don't have to subtract those numbers anymore from your payroll cost. I think that's it, John.
Great, Deb, thank you. Just a couple other notes about loan forgiveness. The statute and the current SBA guidance very clearly puts the responsibility on the SBA lenders for confirming the forgiveness calculations and reviewing all the payment evidence that Chris just talked about. Now, this probably has not been discussed in the news, but I can assure you from talking to a number of banks that there is a lot of discussion going on right now between representatives of the lender community and SBA with exactly how this is going to play out and exactly what does SBA want them to do. Clearly, in the ideal world for the lenders, they would get rid of this responsibility in a minute and pass it back to SBA. And in SBA's ideal world, they would put all of this responsibility on the lenders and have them doing a ton of work to verify all the payments and the calculations. And hopefully, as you can see, you know, the various levels of calculation and evidence that has to be accumulated is significantly more than had to be accumulated on the front end to get the loan. The banks we've talked to are really just getting around to trying to figure out the process for forgiveness. You know, let's face it, until only a few days ago, banks were so inundated with applications that was their main focus, is processing applications and getting money out the door. And for many banks, that is still the primary focus as we sit here today. The banks we're talking to say they are just now maybe starting to think about how they're going to handle the forgiveness process. So clearly no one has yet planned ahead to see how they're going to do that at the end of the 8-week period. But they are negotiating that pretty heavily right now with SBA. What can borrowers do? Whether you just got your PPP money or you're hopefully about to get it, there are definitely some recommendations we have for getting ready and tracking that. Clearly, track the payments. Set up an electronic file or a paper file for those receipts. Many of you utilized our services for the front end calculation of your PPP loan, and hopefully you have seen that in that same smart sheet that we utilized, we've already set up some places where you can start saving those receipts. As Deb noted and Chris noted, you can certainly gather up copies of lease agreements, mortgage documents, evidence of utility services, which may consist of nothing more than at least some utility bills that date prior to February 15th, since most utilities don't have formal contracts such as we see in leases and mortgages. Save those evidence of payments, save those tax reports, 941s, payroll reports. We've had a number of people ask over the last few days, do I need a dedicated bank account or dedicated general ledger accounts for these? The answer is no to either one. It could possibly make sense to have a dedicated bank account. As an accounting firm, we actually think it's a bad idea to have dedicated GL accounts because we think that's going to create more problems down the road when it comes for year-end reporting. Deb?
Thanks, John. So now what I want to talk about is two different things that apply for payroll tax savings. And both of them can apply even though you have a payroll protection loan. Do you want to advance the slide, John? So for the first, it's going to be emergency paid leave. These are the required, I call them mandated family medical leave, paid leave, and mandated paid sick leave. It's payable to employees beginning April 1st, and it's only due to these 5 things. Note, I have different colors. The green is if you're sick, you're in mandated isolation or quarantine, you self-quarantine because the healthcare advisor told you to for reasons related to COVID-19, or you're experiencing symptoms. And the second amount would be if you're caring for a child whose school is closed or the daycare provider is not available. So how much, and the reason I put this in here is a lot of people don't realize these are rules that say you must pay. This is additional leave provided to people. They're under the Department of Labor Family Medical Leave Act and the Fair Labor Standards Act. So let's go to how much you have to pay. Of course, the rules only apply if you have fewer than 500 employees. So therefore, some people with a loan may not have these rules, but most do. How much do you pay? So for the sick leave, you only have to pay 10 days or 80 hours, and that amount is the lesser of 100% of wages or $511 a day. And for the Family Medical Leave Act, you pay 2/3 of wages or $200 a day. Now, these amounts are going to end up being a refundable payroll tax credit. So what Congress has done is they've lumped all of this stuff where they want to get money to employers quickly, and they've run it through the payroll tax system. They run it through the payroll tax system in the form of payroll tax deposits. So when you pay these emergency paid leave, either paid mandated sick leave or mandated family medical leave, remember mandated family medical leave is only if you're taking care of a child, although it does last for 12 weeks, 2 weeks as sick leave, and then 10 weeks as paid family medical leave. When you make those payments, you can offset your payroll tax deposits in the same period in which you're making the payments. So that really helps, such that you're not really funding these at all. Your payroll tax deposits you would otherwise be making for all your employees are reduced, and those unpaid federal tax deposits are funding those payments. The other thing that's important and that some people may not be paying attention to, because again, these rules changed, I think it was last week when some Q's and A's came out. Yes, it was Friday, the last week. So the employer share of OASDI payments, not Medicare, the OASDI, which is 6.2% on the first $137,700 of wages paid to anybody, the employer share of those payments from the time this law was signed until the end of the year don't have to be paid until 2021 and 2022. Now, the reason I wanted to really emphasize this is the guidance was released. They said that it is not available to employers having a loan forgiven. However, the amounts deferred, the payroll tax amounts that you don't send to the government and you will eventually pay in 2021 and 22, don't have to be, you can keep deferring those amounts until you have the forgiveness approved by the bank. So even so, all those taxes for April, May, June, July, those amounts are going to be due in 2021 and 2022. And it's a planning opportunity, I think, that some people don't realize. The question I get all the time is, well, wait a minute, I already sent in the first payroll in April, maybe I sent in the second one too. Well, you overpaid your taxes. In that case, you can underpay your taxes the next time you send in your payroll. So these payroll tax deferrals, as I say, they go from March 27th to December 31st. You'll eventually have to pay them, no interest, but it is something that you can use until your loan is forgiven. So that brings us to what do we think, what should you be thinking about as an employer? First of all, the payroll tax deferral until your loan is forgiven. Again, it's only the employer share of OASDI tax, 6.2% on wages. Then next thing is you have your loan forgiveness for the 8 weeks, which we've talked about, wages up to 100,000 plus annualized plus healthcare costs, retirement plans, state and taxes, rent, interest on mortgages and utilities. And then do keep in mind, and I did see a couple questions on this in the questions you guys have submitted, is that the mandated paid leave payroll, mandated paid leave amounts cannot be used to reduce the, to be included in wages in order to forgive the amount of the loans. However, those that are, they're your employees. If you're paying mandated paid sick leave or mandated FML, they're your employees. They're counted as employees for the fraction test, even though their wages won't be in the. The last thing I want to mention is IRS has waived penalties if you underdeposit payroll taxes because of these payroll tax credits. So you do need, and they're really, you can reduce all payroll tax deposits now. On July 31st, the Form 941, which is the quarterly employment tax return for the second quarter of 2020, that hasn't been released yet. That is going to reconcile all of these credits and deferrals and advances and all of this. So you are going to have to true up everything by the end of the quarter. With that, let me turn it back over to you, John.
Yep. Thank you, Deb. We have put together some ideas of how we can help clients. Probably many of you on the line got our help in the initial application for PPP loans, and we had a great response to that. We had hundreds of companies that were making that mad dash to the loan window, and we were happy to help with either consulting help or helping with the calculations. Our view on forgiveness, and hopefully as you've seen the material today, is that there are a lot more moving parts to forgiveness, and we've been responding to a ton of questions and emails from clients who either are getting their money or about to get their money. So what we've put together is really kind of two options for assisting any of you out there with the forgiveness piece. One option would be on a fixed price package basis. We view this as a planning opportunity, as Deb and Chris have both spoken to, because the clock runs on this 8-week forgiveness period starting the day you get the money, and there are no do-overs, and there are no chances to, at least as it stands, there's no chances to extend the 8-week period. We firmly believe that it really pays to spend some time up front or as early in that 8-week period as you possibly can to plan and forecast out what those expenses are going to be, how they look. We talked about some of the planning opportunities to perhaps maybe not prepay things, but look at certain expenses that could be legitimately claimed during the forgiveness period. Clearly take some planning around FTE counts, around looking at salaries. So our plan is to assist with that front end planning, do a check-in about midway at 4 weeks, and then on the back end, put together all the calculations, check off all the documentation. There is currently no application form for forgiveness. SBA has not even announced whether they even plan to put together an application form. We tend to think that probably each bank will have some kind of a format. Could be online, could be through an Excel document, but there will be some kind of format laid out by the banks. So we're prepared to help with the front end planning, a check-in, the back end calculation. Here's kind of on a package basis. We based it on the loan amount because we know that the loan amount is a reflection of your payroll costs. Clearly, companies that have more people, these calculations and planning are going to be more complex because you've got to look through more lines in a payroll report, look for employees that are compensated over $100,000. You know, the time required gets much greater as the size of company gets greater. So we've kind of priced this into that. Or for many companies who want to try to do this themselves, but would like some assistance just reviewing, answering questions, bouncing ideas off, we are here to do that, you know, just on a consulting basis. And then Deb, you want to talk a little bit about the on the payroll tax side, what we're doing?
Sure. With the payroll tax, what we found was that a lot of people are running payrolls and having to juggle all these different credits and tax deferrals. And so what we did was come up with a tool and have a dedicated team that will help determine whether amounts being paid qualify for the credit, how much of the credit, and then doing some what-if projections for claiming credits. And of course, a quarter-end reconciliation of the Form 941, so that you make sure you defer the maximum amount of payroll taxes that you can and properly claim the credits for the mandated paid leave amounts. We don't have a specific cost because we need to know more about the numbers of employees, whether you're a profit or not-for-profit, how your payroll data is, and how that payroll data can feed into our worksheet. So we have started the process by sending an email to the email on the screen, and then we can talk to you about what the pricing is. But I've given you the range of the prices that we think of based on the number of employees and relationship with Cherry Bekaert. So with that, there were just a couple questions that I thought maybe would be a good idea to talk about. I think there were some questions that talked about paying amounts after February 15th for rent or for utilities that haven't been paid yet. And I think we have to wait for guidance. I would think amounts in arrears could qualify if they're paid during the 8-week period, but it's not really clear that that's what can happen. There was another question that asked, what if I pay recruiting costs? No, that would not be part of wages. There was a question concerning, does rent include rent for personal property like copiers and automobiles, things like that? And yes, to the extent you're in your business, yes. I don't know, Chris, if you or John see any other questions you think we should address.
I think there was some confusion about federal income tax withholding, and just I'll quickly summarize what we're referring to there. When the PPP application process initially came out, there was initial guidance that suggested that you take your payroll and you reduce it for withholding, such that you're effectively only getting credit for net payroll to your employees for purposes of calculating the loan amount. So that later was determined that it really should have been more of a gross payroll test, that there should not have been a reduction for withholding tax. I think Deb mentioned something to that effect. So if your loan was funded, and as some lenders did with the initial calculations, they reduced your payroll costs for those federal tax withholdings, then your loan forgiveness amount is going to be pretty easy because you wound up borrowing less than you probably were entitled to borrow. So when we go to do the forgiveness, it's really going to be based more on gross payroll. And I think when we did our approach, when we calculated it for some people, we used taxable wages, and to the taxable wages, that's what we subjected to the $100,000 limit, so that the employee portion of healthcare and 401k, et cetera, that had been deducted in determining that amount, those all got included in our retirement and other payroll costs. So I think there's some uncertainty on exactly how that's going to enter into the $15,000 number that we're looking at for the 8-week period. If we have to look at gross payroll, then yeah, the employee contributions to health insurance would wind up being part of that $15,000 cap. If we're looking at, if we start as net taxable wages, then I think we would pick up those employee portion of contributions to the health insurance.
Yeah, I agree, Chris. We just have to make sure we don't double count the employee contribution. So yeah, we did talk a little bit about that and what the slide should show, but they didn't. So you get the employee cost, but you don't double count it. There was another question on here about they have seasonal employees. They pay healthcare costs for the seasonal workers, but they don't pay them any wages. I would say as long as you haven't terminated their employment, they're employees, so they would count in your full-time equivalent test, but they won't count as wages having been paid. And I think if you run some projections, you may realize that by not getting the wages to be paid during this 8-week period, even if people are sitting at home or doing, getting paid for 40 hours when they work 20, you're going to be better off to actually pay them, or just as well off paying them as you would be not paying them. It's probably more appropriate thing to say. And one other thing is the last one I know of is somebody said, well, you have a number of businesses, they all have different loans, and so do you have to use the same full-time equivalent denominator test? In other words, you have to look at the same period for each of your loans under the affiliated rules. And no, you don't. Each loan is going to have to stand by itself, and which only makes sense. You look at your loan, and the reduction and the forgiveness of a particular loan is based on its own fraction. So it doesn't matter what action used by another affiliate would be.
And Deb, a couple of things I'll add in. A number of you have asked if the slides are going to be available, and yes, they are. We will get them posted on the website. It's now almost 1 p.m. and I still have not seen any headlines about the House voting or approving the additional appropriation, but stay tuned. That could yet come this afternoon. And as guidance comes out, we are probably expecting that these slides are going to become outdated for some of the details pretty quickly. So we'll try to keep those as current as we can. A couple other quick things I've noticed here in the Q&A. We've had a couple of people say, well, what happens if you don't get it all forgiven? That portion of CARES Act has not changed. Any portion of the loan not forgiven gets amortized over 2 years, 1% APR interest, no personal guarantees, no collateral, hands down, still the sweetest loan deal you will ever see in your life. We've seen a couple other questions, and many of you may have seen in the news, there's certainly been some political or media blowback against some companies like Shake Shack, others who got their PPP money, but many people questioned whether they really deserved it or did they need it. And so, and a lot of people have seen where Shake Shack repaid their money very quickly. There is discussion on Capitol Hill about some kind of a means test or a proof of harm during the 8-week period in order to qualify for forgiveness. As we sit here right now, there's nothing like that in the statute. There's nothing like that in the guidance. And it's anybody's guess whether that will really come to pass. That's more of a congressional debate, but it is worth noting that there are members of Congress that are raising that issue about whether there should be some later test of whether a business really did need to have its loan forgiven in order to survive their forgiveness period. Deb or Chris, I think we're about out of time. And to all of our participants, we thank you for your time. We will do our best to answer questions through email or calls. You've got our contact information here, and we look forward to hearing from you.
Thank you.
Thanks, everyone.